Long-term care is expensive. But see, here's the thing. 70% of Americans over the age of 65 are likely to require some level of long-term care over the course of their lifetime. Now, this amount can range on the lower end of about 2,000 to the higher end, 9, 10, $11,000 a month, depending on the level of care in which you'd require. But what if the answer is right underneath your feet? Or maybe you're not watching at home, but in the event you are watching at home, perhaps the answer is right underneath your feet. What we're going to talk about is how you can utilize home equity to actually pay for a long-term care need. And yes, there are pros and cons. There are different things that you want to be considering, including a spouse, including future heirs when it comes to your home. But ultimately, the focus and the strategy that we want to talk through is making sure that you're able to stay in your home, because we hear it from just about anybody. The only way that we're going to go out of this place is feet first. And we're actually going to talk about one additional way you can pay in a future video. So if you haven't subscribed yet, be sure you do so if you want to look for some other creative ways to pay for long-term care insurance. My name is Danny Sinowitz. I'm a CIP professional, and I have 10 years experience in the industry. And the goal today is to make sure that you have a better understanding of how you can utilize an asset that isn't often associated with retirement assets, your home equity, to help provide for a long-term care need. So we can show all the scary statistics. You're probably aware of them, or maybe you even know somebody who's had a long-term care need. But again, it's very expensive. And if you have to move into a home that requires around-the-clock care, it can really add up and burn through a person's net worth fairly quickly. Now, if you're fortunate enough to have long-term care insurance, you've probably paid a good amount into it. And again, it's not necessarily going to cover every single expense. It's likely only to cover a portion of it for a specific period of time. But the older you get, and unfortunately, as more people do have long-term care needs, the more expensive long-term care insurance becomes. This has led in recent years to more of a non-conventional approach to taking care of long-term care expenses. One of the things that's been utilized are legal documents and trust to make sure that couples or individuals are able to move some of their assets into a trust that's not in their name to protect the assets and make sure that they can pass to the next of kin. Now, these strategies can make sense, and this video is in no way meant to knock those strategies. If you've done that, you could find that the strategy has actually worked out well in your situation, but there are some drawbacks to these plans as well. The first one being the 5-year look back rule. If you're planning to make a gift either to another person or to a trust, in order to qualify for Medicaid, which would cover some long-term care expenses, you need to make sure that the trust was established and had the funds funded 5 years prior to the long-term care need. This also goes if you're planning to gift to relatives or to whomever else you were planning to gift to. But ultimately, that 5-year rule is important because if you have an incoming and impending long-term care need, you may not have 5 years in order to set up the trust and fund it properly. There's also the potential loss of control within a trust too. And depending on the type of trust that you've created, if it's an irrevocable trust, you could lose a lot of control within some of your assets as well. Now, again, it doesn't mean that all hope is lost. This can be a more detailed subject, and you want to make sure that you understand the rules within the trust. But ultimately, if you're giving up some of those assets to the trust, you may not have direct control over them as if you were the individual owner and not the trust. There are also tax considerations that you need to make sure that you're accounting for if you're planning to utilize a trust, and these tax considerations can be quite hefty if not planned for properly. Lastly, there's the actual cost of establishing a trust. And again, I don't want to make it sound like these aren't worth it. It can be a lot more expensive not to have this than if you do have it, but understand that there's an upfront cost to creating a trust if you're planning to utilize a strategy. So long-term care insurance is maybe not an option. Let's say that the trust planning is not an option. There is an option for retirees, specifically ones that have been good savers and potentially have no debt and paid off their home, that they can consider, and that is home equity. Just like we talked about the trust, this isn't necessarily a perfect solution, but there are some real benefits that you should be considering if you're looking at a potential long-term care need in the near or distant future. Two issues often come up when it comes to home equity, specifically for retirees. If you're in the fortunate position that you've been able to pay off your mortgage, good for you. However, the assets themselves of the home are oftentimes hard then to utilize as a retirement tool. Depending on how you're planning to utilize your home in retirement, the asset will hopefully continue to grow as real estate prices continue to go up. But how are you able to actually utilize those funds if you're not planning to move or downsize, or you're not planning to utilize the home equity within the home? These are questions that retirees often have. But utilizing your home as a quasi long-term care strategy could be something that you should be giving consideration to. So we're going to talk through reverse mortgages, and reverse mortgages have gotten a bad rap in recent years, and to some degree for good reason. But there have been some modifications and protections for consumers that have been put in place, which could make this a potential strategy for a long-term care need. The first one that we want to talk to is what's known as a single disbursement lump sum payment plan. And this is a way that you can utilize home equity in a lump sum. This is something that would take place at the closing of the reverse mortgage. So, depending on the amount of the value of your home, you're able to take out so much and utilize a lump sum payment, and it wouldn't be a continuous income stream that you'd be getting. And this should be considered if it looks like it's a more imminent need that you would have. And yes, there are some catches and some costs to be aware of. The first thing that you need to be aware of is just like there would be for a conventional mortgage, there are closing costs. The other thing that you need to be aware of is that there is a fixed interest rate that would be associated with the loan as well. And these costs are really what can allow you to utilize home equity to make sure that you're able to pay for a long term care need. But these reverse mortgages must be repaid either when the home is sold or when the borrower passes away. So again, it can allow the senior to stay in their home if they need to make sure that they would like to pay for this long-term care need. So a single disbursement lump sum can make sense if you have an immediate care need. But this isn't a perfect strategy, and there are also costs involved and potential downfalls if you don't have a strategy in place for this. You can also utilize a reverse mortgage and a normal monthly income stream. And this works similar to how an annuity could potentially work that you may be familiar with. Similar to a lump sum payment, a portion of the home would be then taken over in a reverse mortgage, and that payment then would kick in right away. There are different ways in which you can take these payments, and these payment plans will vary, but this can provide monthly income. And with the cost of some of the long-term care needs, this likely would only help put a dent into some of the monthly costs that you would have, but it could provide stable income if you don't have a super high long-term care need in retirement. Something else you can consider, though, is a home equity line of credit. And compared to the first two examples, this is more of a situation of a what if scenario. A line of credit would likely come into play if you need the funds. You can keep that line of credit and you wouldn't necessarily owe anything on it unless, of course, you plan to actually utilize that line of credit. You can think of it in some ways as an ATM from your home. If you need to take funds out and utilize that for care, that's when you would have the interest rate associated with the normal monthly repayment. Now, with the line of credit, it could be something that you could notice that it could increase as your home value increases as well. But you also want to make sure that you understand the repayment terms. Now, there are two big things that a lot of people want to know. Number one is what happens with taxes. Now, the good news with reverse mortgages would be that the proceeds that you receive are not taxable. They're considered a loan and not taxable income. So in that circumstance, it could be something that you're able to take advantage of if you're worried about paying more in tax. That can also be helpful if your Social Security currently isn't taxable or you want to avoid Medicare premiums. But you do want to make sure you have an understanding of how capital gains tax work if and when you sell the home. Let's look through a quick example. Let's say you're a single individual and you purchase a home for $200,000 and you sell it for $450,000. You purchased it decades ago, so it would count as a long-term capital gain. So even though you have $250,000 of capital gains, you don't actually owe any taxes because of what's known as the capital gains exclusion. This is also assuming that you've used this as a primary residence for 2 out of the last 5 years. In the event you have a reverse mortgage and you owe $500,000, it's okay because the $50,000 difference between the $500,000 and the $450,000 would be forgiven because you cannot owe more than the home's value when the loan is due. However, that $50,000 would get added to the $250,000 gain from home appreciation. So therefore, your capital gains taxes would be based on a $300,000 gain, not just the $250,000. So while you can still exclude the $250,000 from your capital gains tax, you would owe capital gains on $50,000. And the worst part is you didn't actually make any money on that sale. One of the last big questions is what actually happens to the home then? You can still make improvements to the home. You can still sell your home if you decide to, and you'll also see the equity continue to build in the event that the housing market continues to rise. But the loan itself would become due under 4 different circumstances. Number one would be when you permanently decide to move out. Number two would be when you and or your spouse pass away, when you are both gone, or if you're just a single individual, when you are gone. Number three would be if you fail to maintain the property. And number four would be if you don't pay the taxes or the insurance on the property as well. So there could be circumstances where the loan would come due while you're still occupying the home. The surviving spouse can continue living in the home in the event that the one spouse passes away. The loan payments will continue unchanged, and the same reverse mortgage protections that were in place will continue to remain in place. Eligible non-borrowing spouses can still be included in the reverse mortgage so long as they meet 4 criteria. Number one, they were married to the borrower at the time of the loan closing. Number two, they continue to live in the home as their primary residence. And then just like we talked about before, they need to continue to maintain the property and continue to keep up with the property taxes and the insurance. Now, with the heirs or the children, it can be a little bit different. So let's cover what that looks like real quickly. The heirs have a couple different options. Number one, they can actually repay the loan and keep the house. So they can actually look to refinance that reverse mortgage. And then they're able to also potentially look at using other funds to pay off the balance. Generally speaking, the payoff amount is usually the lesser of the loan balance or 95% of the current appraised value. But they can also look to sell the home. And if they decide to sell the home, they can use the proceeds to actually repay the loan. So again, there's likely to be some level of a difference between the home value and the loan itself. In the event that it is, they can use the proceeds to then pay off the loan. At that point, the children are able to keep any of the excess equity. But something that's very important to make sure is that they also have non recourse protection. We talked about this briefly earlier, but what that means is that in the event that the home is underwater, in other words, that the loan is greater than the value of the home, they would not be responsible for the difference. The FHA would step in and cover the difference between the value of the home and the value of the loan. Depending on the strategy that you and your family consider, home equity can actually make a lot of sense as a quasi long term care and strategy. While it may not be the first strategy that you consider, it should be something that is at least understood, can be utilized, and the assets themselves, if you're not planning to utilize them for anything else, can help cover long term care expenses rather than utilizing extra tax assets or Roth assets. But make sure that you subscribe to the channel because we're also going to talk about how you can utilize your IRA to help pay for long term care expenses as well, and some of the tax benefits that you can get by doing so. And speaking of tax benefits, we recently did a video on how retirees can be both charitable and save money in taxes at the same time. Check out this link right here that you can click on and make sure that you're able to see what this is and have a better idea of how you can both save taxes and continue to be charitable to the organizations that you care about.